Welcome back to the Stuff About Money podcast. I am your host today, certified financial planner Erik Garcia. I gave Xavier the morning off today, so it's going to be me and our guest for today. Our guest is Miles Clark. He's a senior analyst at Nasdaq Dorsey Wright. Nasdaq Dorsey Wright, they're a firm known for decades-long leadership and momentum and relative strength research. And we're going to talk about that here in this podcast. Miles spends his time studying market leadership, all the underlying trends that drive long-term investment performance. His strength is really translating complex market behavior into clear, actionable insights for advisors and investors alike. Now, the best thing about Miles that I recently learned in our conversation that he is a devoted Saints fan. He bleeds black and gold, y'all. So that makes him both resilient and an eternal optimist, right? Saints fans, we are eternally hopeful. Some might say delusional, but
Well, I was saying we might have to start doing podcasts more often, right? The weekend before we jump on, right? It's the 8th today. I'm not sure when it's going to be coming out, but the weekend before we get a big win against the Bucks, they're not the most relatively strong team as we talk about relative strength in today's podcast. But hey, listen, we can always nice to get a win against a division rival, right?
yeah. So there you go. There you go. There's your definition of relative strength. Bet on the winners.
Yeah.
Like we are not. We're not putting money on the Saints, Miles. We're not betting money on the Saints. That'd be interesting. Who are the teams? So this is gonna be a little bit prophetic because when this is gonna be like we're recording on the 8th, this probably won't publish until later in December. So who are you betting on, man? Who's
Well,
gonna
I
win
think
it?
the Broncos are frauds. I think they're kind of led by Bo Nix and Sean. Every time Bo Nix throws a football, they're like, oh, it's Drew Brees-esque. No, it's not. I'm just gonna throw that out there. Sorry to upset any Denver fans that are listening. I don't know, maybe few and far between. I think the on the NFC side, right? It's kind of who's going to win. Luckily for us, nobody in the NFC South is going to do it, in my opinion. And we'll just have to see, right? But Patriots and things like that, they're over in the AFC. But
Maybe the Packers. You've betting the
Packers,
Packers.
yeah, Packers. They looked really good last or yesterday up against the Bears.
Yeah.
So we'll just have to see.
Yeah. Anyway, we're not here to talk about football.
We could be.
We could be because
Yeah.
like I mean by the time this drops, everything we're talking about is probably going to be different. We're talking about the stock market. Now, we could talk about things that are happening in the economy right now, and that may or may not be relevant a month from now. However, if you've listened to me long enough, you know that I believe in long-term trends in the stock market. Making money in the stock market successfully sometimes has to do with ignoring the noise, ignoring everything that's going on, right? The market is so full of noise, things to get us all riled up. We get all excited, we get all scared. But there's something that's really interesting, and I heard you talking about this, Miles, in an interview about the. This is people listening may have heard this before. Time in the market versus timing the market, right? Timing the market, you try to guess when's the best time to get in. Time in the market says, I don't know when the best time to get in. Most people don't. So the successful investing is staying invested for a long time. And you mentioned this really staggering statistic that like 100% of the time, now there's no guarantees with the stock market. However, 100% of the time, the market has always recovered from any pullback. I mean, that's just the reality.
Right.
I think your stat was over a 30-year period. Over every 30-year rolling period, the stock market was up 100% of the time, meaning you would never lost money if you're a
I'll
long-term
do I'll do
investor.
you better. Over every 30-year period that we looked at the market. Now, this was from 1950 to data in mid 2025, right? So
Okay.
pretty big look back period. 100% of the time, the market was up over 1,000%, to kind of take it a step further, right? And so obviously, like you said, nothing is a guarantee. The next 30 years are not going to be like the last 30 or 50 or 75 years were. But as we kind of, look at this idea of time in the market, we don't have the chart on screen here, but over any 1 week period, markets are positive around 60% of the time. right? Over a 2 week period, 61% of the time, a 1 month period, 65% of the time. So most of the time, there's a small upward bias in the near term at any one point in time, right? But point is, over a 10-year period, markets are positive 97.2% of the time. So pretty darn close to 100% of the
What was
time.
that period again?
That would have been probably somewhere in the lost decade, right?
Okay.
This kind of idea that we're,
Okay.
2000s.com bubble into
Okay.
the GFC. So, that's kind of the idea that, hey, listen, in the short term, there's a lot of headlines that are trying to persuade us to go one way or the next, right? There's
Mhm.
government shutdowns, there's tariffs, just to name a few in 2025. In the short term, small upward bias, but it's really a crapshoot, right? Whether we're positive. But in the long term, this idea of just continuously investing in the markets has really been the name of the game to building kind of secret, quote, generational wealth.
Yeah. So on this idea of long-term investors, most of our clients, most of the people we work with are long-term investors. A question that I hear regularly, and especially more now because the market's kind of been growing really over the past few years, even though there's been a lot of volatility this year. Market's getting expensive, as people are saying, because these stocks are trading at such high prices. Question I get is it a good time to invest now, or should I wait to invest my money until, the market pulls back? How would you respond to that?
It's a really good question because this idea of perceived, in air quotes, perceived value is so important, right? People want to feel, not as we just get into the holiday season, people want to feel like they're getting a good deal. They want to feel like they're getting a good deal in the market too. So
Mhm.
taking that last study and then kind of building on top of it, especially as in 2025 for the S&P 500, we sit at all-time highs.
Yeah.
We get this question all the time, right? From advisors and individual clients who are calling in, that exact same idea. Should I put money to work today, or should I wait for us to cool off of all-time highs? Now, we ran through this scenario. We essentially created three different portfolios. Okay. One is going to be what we call our average Joe portfolio, right?
Okay.
All of our portfolios here, the three of them we'll look at, start with $100 and they end, or excuse me, contribute $500 each month. Kind of like, hey, we're saving more money out of each paycheck or whatever it may be, right? So all of our portfolios are going to do just that. The average Joe portfolio does that no matter what, whether we're in a 20% decline, whether we're at all-time highs, whatever it may be, right? Month in, month out. They're just
Stays
dedicated.
committed to his plan.
Correct. Committed to the plan.
Okay.
Then we have two other, more skeptical or scared investors. The first one's going to be our skeptical investor.
Okay.
Now he starts with his $100 and he invests at the end of every month his 500, right? But if the markets are at all-time highs and overbought, so overbought is this idea that, hey, maybe we're not getting a very good value for our contribution right now. If markets are at all-time highs and overbought, he doesn't contribute. He just saves that money and then waits until we're not overbought anymore, right? He comes back down to kind of normal, right? So
So in
this is
the
the
end,
investor that's
his contribution is equal to average Joe. He's just trying to wait till the market's not overbought to where it's a little bit less expensive.
correct. Exactly.
Okay.
So that's the second portfolio. And then we'll take it a step further. So now it's the exact same scenario, right? We have our $500 contribution at the end of every month. But now this scared investor, as we'll call him, only deploys that saved up cash if we're overbought and we're at all-time highs. He only deploys it when the S&P 500 is now oversold. So he's trying to time the market, right? He's saying, hey, I'm not going to buy up here. I'm going to buy when I think I'm getting a really good deal, right? Does that make sense before I
Yeah.
step through the
Yeah, let's
results?
let's put a pin in this real quick and talk about this. So this
Yeah,
this is interesting. As kids, right? We're taught the way to make money is to buy low, sell high, right? So your scared investor, what's crazy is in the market, your scared investor is buying when there's positive news. Everything feels good, and they're buying at an all-time high, right? Because that emotion of fear, they don't want to buy when it's bad. They want to buy when it feels good. So the market is most expensive when it feels good, when we're excited. So your scared investor is making a the bad decision, right? Because they want to buy when it's really expensive because that's when they feel the best.
Yes, yeah, essentially.
Yeah.
And so, this idea that, hey, we want to make sure that we're getting good bang for our buck. The point is, in terms of going through the results, right? We have our three portfolio, the average Joe who's stuck to their plan, or the other two guys who, aren't necessarily buying all the time. They're not always contributing. They are always saving, but they're not just, continuously buying the market. Their portfolios do quite well, right? The value of that since 1950, they're all over $23 million, right? 24, 23, and 23 and a little bit more change. But point is that the average Joe portfolio, the guy who just continuously kept buying no matter what, he's the winner, right? By about $1 million. Now, obviously, it's not going to be the same in every scenario, right? But just as a kind of sandbox model, your average Joe who stuck to the financial plan, who just continuously was buying, whether they were scared or not of market pullbacks, they're the ones who are, or emotionless and are most successful is a relative
Yeah.
comment, but you get the idea.
Maybe not emotionless. And I think a skill set of successful investors isn't not being emotionless because it's hard not to be emotional about money. It's recognizing that emotions are not good drivers of strategy. Emotions are terrible advisors. That successful investors allow their emotions to don't allow their emotions to drive investment decisions. And I think that's the takeaway here that for the long-term investor, just because there's certain companies that are running really hot right now, and you may or may not own them, you may or may not have a lot of exposure in them. We're talking about a short period of time over a long lifetime of investing, and I think that's the important takeaway here that I really want to drive home for investors. On that idea, I know something that Nasdaq Dorsey is really big on is I think y'all call it breadth of the market. So essentially, what that is, how many stocks are participating in rising markets, and for a really long time now. I don't think this is necessarily abnormal historically. There's always market leaders, but it seems exaggerated over the past few years where just a handful of companies are driving market performance. So y'all would say breadth of market is really low because not many companies are participating in the growing markets. And we've all heard the Magnificent Seven, right? The big seven companies um, are the ones driving it. Explain a little bit more about breadth, why this matters, and the impact that it has on investors.
So, at a very high level, the way that I like to talk about participation is bringing back some football analogy.
Let's go.
And so, when we think about participation, you mentioned market breadth, they're going to be one and the same, right? And it's this idea of how many stocks are moving higher. Now, here's the football analogy. Breadth tells us whether we are on offense or on defense, right? If we are starting here at kind of the low field position, they just, uh, kick off, we're on the 25 or what is it, 35 now. But we're there. And then ultimately, right, helping us decide, hey, are a lot of stocks moving forward, right? Are we all moving higher together? Are we attacking kind of high field positioning? Are we attacking the end zone? Our market's moving higher. Or conversely, if participation is narrowing, right, are we on defense, right? Are we trying to protect against a washout or a touchdown? So, hopefully that kind of provides some context. Point being, most productive market environments occur when when breadth is improving or expanding. The other kind of analogy is generals versus soldiers. If you're not a football listener, right? If you send out an army, and you only send out the generals, right? If you only send out the Magnificent Seven time after time after time again, ultimately they will be, no matter how good they are of generals, ultimately they will be overrun, right? So you kind of need to have the soldiers in there to help support. So that's kind of this idea of, hey, we also need to see not only the big stocks do well, but other stocks as well, small caps, kind of the average S&P 500 stock. Other areas in the market can help improve breadth and kind of make for a constructive market environment.
So what do we see now? We've seen seven companies really kind of carrying the weight. What about the 493 other
The other
companies?
493.
Yeah, the 490. So specifically the S&P 500 is what we're talking about here. So that may or may not include small caps, but
Right.
um, or doesn't include small caps. What are we seeing those other four? Are we seeing increasing participation?
So, when we think about increasing, right, the kind of market backdrop that you just presented was in 2023, where it really was just those seven guys, right? We are, in terms of current market pictures, we're higher than we were in 2023, largely higher or at least on par with where we were in 2024, but we're off 2025 highs. So this is something that's going to be really important as we move into 2026 is do we head back to a market environment that is just dominated by seven names, or do we kind of move higher again? So I think to answer your question honestly, we are better than where we were in a more narrow market, but we're not necessarily where I think we want to be as we move into the next year.
So let's talk about that for a second here, specific to risks that investors run into. So when market leadership becomes really narrow, so when there's a handful of names that are really driving everything, and we start to see these valuations of these companies stretch. I mean, they're getting expensive, right? I worry for a a bad earnings report with some of these bigger companies. There's two risks. One, portfolios underperform, and if they're not heavily allocated to those few leaders, those few winners, um, and the same winners have little, room to disappoint. So if you're too exposed to them and they do disappoint, that's a problem for investors again. So how do you think investors should be navigating both the underperformance risk and the disappointment risk when breadth is low and leadership is as crowded as it is?
So we'll start with the second point. I think that's the easiest answer. Um, when market breadth or when markets are so reliant on just a couple of names, it makes it a little bit easier to actually go out and hedge. And when I say hedge, I mean, you're buying puts. We won't get into the mechanics of risk mitigation and things like that. But my point here is that we don't necessarily have to focus on protecting against the entire market. Right. Obviously different. Don't take that as a blanket statement, but we don't necessarily have to focus on protecting against the entire market washout. We really just need to protect ourselves against where we're over concentrated in our portfolios. Right. And so doing that allows you to take some, calculated earnings play or earnings related options outlays where you're essentially buying insurance on your portfolio. You think about car insurance. You don't use it all the time, but when you do, right, around an earnings release or around a car accident, for instance, it can certainly pay dividends to be able to do that. So I think that's the most practical solution to kind of concentration in markets. You're selectively hedging, different parts of your portfolio. And then the second part would be a return to the first part of your question, which was, what to do about the underperformance risk. Now, Dorsey would just say, because we're trend followers and we're momentum followers, you're just going to take what the market gives you, right? You're going to be more invested in the core of the market. It's not necessarily as fun as going out and picking a bunch of individual stocks, but
Mhm.
the market's telling you what's strong. I've got one more little ramble here, then I'll let you jump
Yeah.
in.
No, you're
A
good.
lot of people think that the benchmark is the thing to beat, right? Because that's exactly what it sounds like. It sounds like the benchmark. But a lot of people do also forget that the benchmark is just another group that is vowing for your investment, right? The benchmark, in this case, the S&P 500, can either be very strong or very weak. A lot of cases we're trying to beat the benchmark. We always are, right? But in core dominated markets, a lot of the risk is actually just not keeping up with the benchmark because it is so strong. So again, we would say we're going to focus on what is strong, that being the core, that being those select names, and then going to go out and decorate our portfolio with a couple of other strong areas. So we're not trying to get cute. We're not trying to go and pick the two areas that are better than the benchmark. We're going to focus on those names and then, let price tell us when we need to look elsewhere. Does that make sense?
Yeah, yeah. Let's talk about benchmarking here for a second. I think this is a warning for investors. Benchmarking can be dangerous sometimes because I like to use the S&P 500 as a benchmark because that's what most people's reference point is, right? So benchmarking basically is you have an investment and you're comparing it to something, right? And that something is the benchmark. Benchmarks can change when we compare investments, so it's really important to identify what benchmark you're using. But I think always trying to, from a performance standpoint, the investor is always trying to beat a benchmark. It doesn't take in consideration some really important factors about the investor's particular investment profile, right? You might not have the investment capacity to try to beat the benchmark. Maybe your portfolio has fixed income in it because that's important to you, because stability is important to you. And if you're trying to chase an S&P benchmark, you're rarely going to beat the benchmark on in positive markets because you have that let's call it the fixed income drag on the portfolio. It's not a drag, not in a bad sense, but it's pulling money away from equity growth. Now, the reason you have that fixed income is because in challenging markets, that fixed income kind of acts as a ballast, right, for your portfolio. Hopefully, doesn't always work that way. Didn't work that way in 22, but that's the point of it. So trying to always beat benchmarks, um, you have to ask yourself, what is my investment profile? What's my capacity for risk? And is that really what I'm trying to do? And those are a lot of the conversations I have as an advisor with clients is, benchmarking performance. Am I beating the market? Am I not beating the market? And some of the hard conversations are, no, you're not beating the market. That was never the goal. The goal was never. It's like almost saying say you're 55 years old and you're getting back into fitness and you're trying to compare yourself to a 25-year-old CrossFitter.
Right.
Benchmarks are different. You're never going to be able to deadlift that much,
Yeah.
right? The goal has changed. I think that's the analogy doesn't always totally hold over to investments because I don't think risk tolerance is age dependent or risk capacity is age dependent. I think there's a lot of other factors that go into it. But from an underperformance and overperformance standpoint, definitely has to be taken into consideration. Let's kind of let's segue because we were kind of talking around it a little bit about Dorsey Wright's investment style. We call it relative strength or momentum. You talk about being a trend follower. When you talk about trend followers, sometimes it doesn't always have like a good, depending on the context. It's like, oh, these guys follow trends. That's just,
Yeah.
be your own person, Miles, right? Why are you trying to
Right.
do what everyone else is doing? Don't keep up with the Joneses. Be your own. Start your own trends. Talk a little bit about what is relative strength, so we kind of have some context here.
Yeah, no, I mean, listen, nowadays, relative strength, technical analysis in general, when you say that, I deal with this with my friends all the time, right? Who are, oh, you're just on TikTok, you're just looking at crypto coins and you're doing all that. No, it's much more
Yeah.
complex than that. Of course, we can do that, but Dorsey Wright specifically is going to be kind of more long-term focused, right? And so what we're trying to take advantage of is long outstanding trends in the market, right? That shift over time. Because, you know, I didn't come on here just to tell you that time in the market is the most important thing, right? We want to be invested over 50 years, but in what, right?
Yeah.
Two different stocks can have vastly different return profiles at any point in time, right? Not only two different stocks, two different sectors, two different size and style groups when we talk about large and small caps, two different broad asset classes when we talk about precious metals or commodities or domestic equities. So there's a lot of, hey, be in the market. Which one, right? And so
Yeah.
Dorsey Wright uses relative strength essentially to say these are the assets, these are what you want to be invested in during your time throughout the market. What parts of fixed income look strong right now? Which ones look weak? So kind of having this idea, we specifically use something called point and figure methodology, which tracks price. We won't get into all of that today. I'm certainly more than happy to get into it. But it essentially allows us to harness price to tell us what is strong and what is weak. Just again, over long periods of time, not necessarily focused on, what's happening in the news today or the fundamentals, which maybe we'll get to a little bit later on.
So you talked a little bit about. So I think when we talk about relative strength, the question for me, it begs the question, like, relative to what? Strong relative to what? And we talked about performance, underperformance, and overperformance relative to a specific benchmark. You talked about, fixed income, what fixed income is relative to other fixed income. So I think that's a really important starting point when we're strong compared to what?
Yeah, it's
So
a very good question. I mean, to each other necessarily. So you have to have the proper universe. Most stocks we're going to compare to the S&P 500 equal weighted index, right? But obviously, small cap stocks are going to have a different kind of background, and we're going to compare it. This idea of relative strength is really important, right? It makes sense when you think about upside, right? If the market is up 5%, and by the market I mean the S&P 500, if the market is up 5%, it's very easy to understand that we want to be in the stock that's up more than 5%, right? That's what we call positive relative strength. Right. Conversely, though, let's think back to a market like 2022 or, great financial crisis, dot-com bubble, any year where, we aren't doing as well. We can also earn positive relative strength by being in stocks or assets that are down less than our benchmark. So if the S&P is down 10% and we are in an asset that is flat, well, we have done relatively well. So it's about finding the proper universe for comparison. And Dorsey Wright does that on the system. So it's not Miles saying, I think this is the proper benchmark, right? We've gone through kind of systematized that kind of background process. But again, finding and earning positive relative strength is just trying to pick those assets that are doing relatively better towards the up or downside than their benchmark.
Yeah. So I'm curious to hear from your perspective when you have wild movements in the market, like 2025, like we've had some wild movements in the market, like very big movements that have happened really close to each other, right? So if you don't have some type of investment philosophy, markets drop 10%, you freak out, right? Like you're a skeptical investor or scared investor, and you're like, I'm out. Then next day you missed out on the 6% return. I don't know the exact numbers, but like we saw wild swings in market. How does relative strength, like what time frame are you looking at when y'all are making these, your process of making decisions? Like when do I replace some of my market leaders because
Yeah.
wow, this guy's down like 20%, but that's only a 2 week period. Like how long, like what's your typical period of
It's
time?
a really good question. And what we do is we take some of that off of ourselves by only looking at specific cadences. So we don't necessarily have hey, we will only look every month. We will only look every quarter, right? When price necessitates that we look, as in one asset has vastly underperformed another enough, right? And we can get into the enough and kind of the mechanics of that. We use different methodologies kind of behind the scenes. But, most of the time we have a portfolio that again is not necessarily looking every day, right? But we will look every month, every quarter, whatever it may be, to help us weed out some of those very sharp intraday moves. But point is that we're not making a trade every month. I kind of talked backwards to
Yeah.
myself there. We're not making a trade or change every single month, but we don't necessarily want to focus on the big intraday swings because I agree with you, right? I mean, when you get the tariff announcement, let's just think about that in April, right? Markets are down 5%. And then in about a meeting in an afternoon, it's funny, we're all sitting in there. And then we're watching markets rip like 6 or 7%, 8%, whatever it may be in the meeting over the course of 30 minutes. And we're like, oh my goodness, right? Like you don't want to be making decisions based on that because those are emotion driven decisions, right? We want to allow these stocks, allow these trends to play out. Momentum will never be the first one and it will never, or the first one in or the last or the first one out, right? We're going to kind of let trends tell us. And if you miss a percentage point or two on the way in on your entry, then that so be it, right? But that long-standing, outstanding trend will allow you to kind of not necessarily
Yeah.
miss things as they come.
Yeah. Now, it's interesting about relative strength. We talk about investing style like factor investing. Momentum is a type of factor investing. We talk about the different types of factors. It seems like relative strength is a little bit agnostic because, like, whether growth is a leader, whether value is the leader, whether it's quality, it really doesn't matter to you guys. You're not a growth investor. You're not a value investor. You're just looking to see who's leading the way, and we're
Yeah.
going to rotate portfolios into that space.
Yeah, no, that's a very good point. I mean, we are not, focused on any one specific thing. It's really whatever is leading, right? So just to kind of give some context, late 2022, or not necessarily late 2022, but 2022 in general was a really productive year for momentum because essentially what we were able to do was underweight technology, which is a big weight in the market, right? Technology was not doing well in 2022. So we're able to underweight technology and then overweight other areas that are doing well, right? We talked earlier about, what are finding those assets that are doing well when others aren't, right? Energy, utilities, kind of other areas that are more risk off, you're able to overweight those comparatively to the market, and then ultimately kind of shift around, and then ultimately rotate back in 2023 and 2024 into more tech. So we're not just going to focus on, hey, what looks cheap right now, or what looks like it's growing really, really fast from a multiple perspective. It's going to be what is price telling us is strong.
So, okay, as a technical investment firm looking at charts and whatnot, where where is there a place, or is there a place for y'all to sit down and say, okay, where are things going right now? We got, the AI trade. Everyone's talking about the AI trade. Is the AI trade over its skis yet? Is it, is it time for to pull back a little bit? You look at, and you mentioned energy, and when you said energy, maybe think about this. Like, look at what are industries that are going to benefit from the AI trade. Is energy one of those? I mean, we're seeing some, energy's been doing great, right? Because we have to generate so much power. Like the numbers, the amount of electricity that we're going to have to generate to to run these data centers is just mind-boggling. Like it's paradigm shifting, right? So is there any place in y'all's philosophy that says, hey, what are maybe some of the fundamentals or the long-term trends, and then we're going to go back and say, maybe we do want to take a little bit more exposure in energy, or maybe we do want to take a little bit more, or is that just totally y'all rely totally on the trends and like, hey, if energy continues to trend, we're just naturally going to have a more exposure to energy. Is that the way y'all look at it?
It's the latter. Now, I do not want to come on here and say to any fundamental listeners or go those that are more interested in the fundamentals that I think that their stuff is hogwash. It's certainly not. Most times, people will come and they will use Dorsey Wright to make sure that their fundamentals are strong. So they'll have a list of 20, 30 stocks, whatever it may be, that they like from a fundamental perspective, maybe that they think are going to be trending, or hey, we're on the second or third order of the AI trade, right? Then they'll come to Dorsey Wright and they'll say, what do the technicals look like? Does the market agree with me? Right? Because here's the thing, the markets are so interesting. We can be a stock can go up in our favor for not the reason that we thought it would,
Hmm.
right? Maybe, maybe we think, oh, well, we're going to be producing so much electricity that the utility stocks have to go up. But maybe it's not that at all. Maybe just whatever. Maybe they cut costs right somewhere else, and that's the reason why I kind of flew through price. So point is that people will come to us for the technical side on their fundamental reads. So again, we're not discounting it, but that's not necessarily our lane. It's playing the piano with both hands.
Yeah. So as y'all kind of sit kind of where we kind of find ourselves in the markets, in the economy, where, by the time this airs, maybe there might have been a interest rate cut, maybe not. It seems like everyone's thinking there's going to be. When these type of events are scheduled to happen, when you look at earnings reports or potential interest rate cuts or policy change, as an investment team, how do y'all anticipate? How do y'all prepare for, or do you?
It's more so about what the resulting price action is, right? And kind of going back to one thing that we talked about earlier, if a stock has a bad, let's focus on earnings just for a second. If a stock has a bad earnings report, right, they might be down 5, 10% if it's really bad, right? But Drew Brees trotted out there and threw an interception every once in a while, right? But he's still an all-time great. And so kind of this idea of we don't necessarily want to penalize or punish stocks that are otherwise technically sound because they have a bad day. Now, maybe you can make another conversation on the interest rate deal. If we're entering a cutting phase, right, does that have more of a long-term trend for different areas of the market than others, right? But in terms of earnings and individual reactions, those aren't going to be a big priority for us, but they still matter because prices change. And when prices change, that's what matters to us. Does that make sense?
Yeah, yeah,
Okay.
yeah. All right, we're coming up against the clock here.
Sorry, I ramble.
No, no, dude, that's great. No, I'm enjoying our conversation. I appreciate as well the Drew Brees comment. You could have also made the Peyton Manning uh comment that how many
Could have.
how many interceptions did he throw in his first year?
Oh yeah, yeah. He's the real one. I would think a bunch.
Yeah, still want to bet on him for the long term, right?
Yeah.
So as we're wrapping up here, I'd like to just hear your perspective on 2026. Are you feeling hopeful, cautious, opportunistic? Kind of what are you thinking moving into 2026?
Well, from a personal level, I'm getting married next August, so I think it would be my fiance
Be a
would
great
have me
year.
here. Yeah, so it's gonna be
Oh,
wonderful. So that's that side of things. But from a market side of things, I think the biggest thing that we really need to watch is what we talked about earlier with the participation, right?
yeah.
We want to see expansion from the other 493, but I want to emphasize participation and performance can diverge, like we saw in 23 with the Magnificent Seven. But point is that overall, in the long term, domestic equities still remain quite strong. Right. Other areas as well, which we didn't get a chance to talk about today. International equities doing well. Commodities and precious metals have certainly been, a lot of calls about that. But for the most part, we're still seeing a pretty risk-on stance across markets, which, is a positive ultimately.
Yeah,
So cautiously optimistic, maybe is the translation for a soundbite.
well, here's what I would say. Here's what I would say. If indeed you're a long-term investor, and if you believe the stat that 100% of market pullbacks have always recovered, it's history. I mean, that's not a promissory statement, right? If your stat, and not if, it is true that over a 30-year period, long-term investors are going to grow their money, um, you should always be optimistic on the market if you have
Yeah.
the right time frame, and that's what's really important. Here's something that I'd really encourage investors to do is make sure that your portfolio is properly invested for your capacity for risk. I think far too often we focus on risk tolerance. Like, what's my tolerance for risk? My risk. Do I want? Am I risky or am I scared of risk? And I think risk tolerance is too closely tied to how we feel about the stock market. When the market's doing good, man, my most conservative clients want risk. It's amazing their appetite for risk. When the markets are doing poor, it's amazing how my riskiest client doesn't want to lose money. And I think that tolerance is too closely tied to emotion. So we talk about risk capacity. What's your capacity for risk? Can you afford to be invested in the market, for the market to drop a little bit, for you to recover? I think that's more of an indicator of how your portfolio should be invested. So, regardless of what 2026 looks like, whether it's a good year, whether it's a bad year, it's important to make sure that your portfolio is invested in a way that's consistent with your investor profile. So, if you haven't had that conversation with your advisor in a while, highly suggest it. If you don't have an advisor, we'd love to have a conversation with you. Miles, I'll give you the last word. What you think?
Yeah, I mean, I'll tell you this. There's a one. First off, great. I appreciate you having me on. I'm happy to do it at any point. The last point that I'll kind of end on here is be okay being wrong in life, in your investment portfolio, whatever it may be. Momentum trades are good at being wrong. In fact, momentum is wrong about 55-60% of the time. It's the few investments that momentum will ride in your portfolio, and that's what makes it a productive factor. So, point being, be okay being wrong. Be emotionless in how you're able. Again, I don't want to say emotionless, but maybe that's more emotionless than emotionful or driven by emotion. Be okay cutting names within your portfolio. Be okay kind of picking the weeds is what we say, right? Be okay picking the weeds and replacing them. And don't get too attached to any single investment. There's a lot of people who are buy what you know. They love Chipotle. They eat it every day, but Chipotle isn't a great stock right now, right? Nvidia, they're attached to the gains that they have with Nvidia, right? Be okay, not being necessarily wrong on Nvidia, but be okay, understanding and looking at when it's time to make a change, if you will.
Yeah, your portfolio doesn't love you. Don't love your portfolio.
Exactly. And always follow the financial plan. I get that. That's
Yeah.
my last word. Go ahead.
Yeah, I stick to the plan. That's right. I like that. Stick to the plan. Root for the Saints. No, dude,
Next
I
year.
will make this confession here. I am delusional when it comes to the Saints. I got no problem. Like, I am. Saints are 3-10 or 3-10 as we stand today, and in my mind, they're winning the Super Bowl this year, even though
I,
they have
I think
been
that might be
statistically
mathematically.
eliminated.
As numbers guys, I think you and I would be bad to say they were not mathematically eliminated.
I'm a far better investment manager, financial advisor, financial planner than I am picking who's going to win the Super Bowl. But Miles, thanks for coming on today. We appreciate you, appreciate Nasdaq Dorsey's partnership, the research that y'all put out. We use it, we love it. So as we always say, y'all go out there, plan wisely, live confidently.